This is fascinating, I must say. We take a step back, say a few months or so, and we observe the Saudis purchasing about 1 million shares of SLV. In comparison to their cash on hand, that is a mere drop in the bucket. Still, it's cause for concern that sovereign nations are getting involved in the silver market. Yes, but in a very subtle way. However, the most crucial aspect is that they are a large enough buyer to demand actual silver. This could potentially hurt the silver shorts because now a nation state owns shares in the SLV and can demand their money back. I would like to change this for actual silver. I guess you might say that's threatening. It's at least something that would provoke some thought on their part. The next step is to prepare to lower the commodities price by shorting the company, SLV. Where do you get the idea for that? Yeah, that's not too complicated. Time and time again, it has been done. The idea is to keep selling virtual silver until there's enough pressure to bring the price down. But you increase the margin requirements if that doesn't work, or doesn't work as well as usual. If you were previously required to put up 10%, you can now argue that you had to put up 15% after raising them. And if that fails, you increase it until you are required to put up 20% of them. If it doesn't cut it, you'll need to put up 30% more. Moreover, you might increase it to 40% in case that is ineffective. So you keep removing the middlemen, particularly smaller trading funds that claim they won't participate because they lack the capital or just don't want to risk losing money. As a result, the selling pressure is increased. Thus, I anticipate seeing that in the near future. Is that additional margin is being required? And what might happen, I stress could not since we're entering uncharted ground, if half century is within reach. Contrary to popular belief, the market is behaving more strongly than anyone anticipated. The SLV and the international retail sector are two examples of the kinds of forces you described. The silver market is also showing signs of activity, thus proceeding accordingly. Could we find ourselves in a scenario where physical demand for silver blocks surpasses or dominates the paper market? In this case, it wouldn't matter how much you short. Just give me the silver. This is an absolute necessity for me, and I am willing to pay top dollar for it. Here it is. There's going to be a holdup. Not that I believe such to be true, but it gives the impression that such is happening. I prefer to keep my enthusiasm in check here. My goal is to maintain composure and objectivity. But the truth is, as you so eloquently stated, that there was backwardation, retail buying, and shorting of SLV shares, which is now illegal. When you sell, but the price doesn't go down, what gives? So that's basically what the SLV is doing. They're pumping out inventory at a rapid pace, driving up prices. That's perplexing. It was successful in the past. Now it's working, so why isn't it? Yeah, I think that's a fantastic inquiry. I wish I knew the definitive response. I'm not attempting to boast here. I just don't have a feeling. That much is obvious. The fact that I've been in this industry for decades gives me a leg up when it comes to predicting its future, because there aren't many individuals in my position with my level of experience. In my opinion, it's getting ahead of itself. Nevertheless, a revision was made by Alan Hibbert and Mike Maloney. Have you sold it? Possibly every day. You have no idea. Remained observant. They did one about how it's different this time, albeit I don't always watch them. In addition, Alan demonstrated the number of trading days when silver was above 40. I believe it was 7 times in the 1980s, though I can't remember the exact figures. After then, it was like 17 times in 2011. Oh, and this time it's like 20, if my memory serves me right. Accordingly, that is indicative of a robust market. Like the $50 mark in 1980, you want to see that 40 handle in a one-day or one-hour event. Sure, it touched 50, but that level of performance couldn't be sustained. However, we are now able to sustain 40 for longer periods of time than before. We are where we are, to cut a long story short. We might easily break past 50 and continue moving higher, which would be disastrous for the shorts who are now betting on a lower SLV. Traders' dedication seems good to them, but not excessive. They are making every effort possible with this margin item, which they have only increased once. If margins increased today, I would not be shocked. they will gain command. Something like, I'm going to buy back my short, may happen if things turned out the way I described them. This arm discomfort is too much for me. While extremely unlikely, it is not impossible. Therefore, if the bail or any of the other three big bullion banks, which have a history of holding large short positions, said, I can't take it anymore, etc., I intend to repurchase it. Pressure to buy, not sell, is what that is. Acquire the cost. In other words, I am unsure. In my opinion, it has room to grow, perhaps reaching 50, 52, or 53. You have no idea. Their unexpected victory causes them to impose sufficient margin restrictions, causing the market to fall again. To be more specific, I'm basing my actions on probabilities. The margin requirements always grow up to the point where you need cash on hand, or a margin account if a market runs amok, like Palladium did in the early 2000s. What does it mean, then, if the price of silver is $50 for a 5,000-ounce contract? 50 times 5,000 equals 250 grand. What do you think about that? Figure it out anyhow. That means you can't put up 10% plus $25,000. You have to put up the whole amount. You must invest the entire $250,000. We have ourselves a cash market. As a result, the cash market is being pushed into the futures market. That was done at Palladium. And you know what? It fell short. Beyond that, they truly nailed it. As a result, I was able to capitalize on 4 contracts in Palladium. Plus, I can't remember where I got it, but the price is just too exorbitant. I must investigate. The 200-point swing to 300-point swing prompted my broker to call and tell me to increase my margin. More profit margin, my darling. I wish I could buy more. Looking forward to a low foundation, I was thinking. With the additional funds in my account, I may add 1 or 2 very cautiously. Came to be? Oh no, it is irrelevant. Here you go again. You currently have all this additional money in your savings for the future. All markets, long and short, are seeing an increase in the margin requirements. I found out the hard way about that. As I mentioned before, that was in the early 2000s. I've been involved in futures trading for a long time. I had no idea, but that's definitely a possibility. My only advice is to proceed with care, particularly if you're using leverage. You know, if I were in the market for any contracts, whether it's 10 or 100, I'd be selling them now, cashing in my winnings, and then waiting for the price of silver to stabilize. Having said that, I expect to receive a great deal of hate mail if it goes to 60. However, as someone who has been playing for a long time, I can tell you that it's usually beneficial to sell at a strong point, because once the market starts to turn, it becomes difficult to sell. The more sells you sell to, the more sells you sell to. Then, what is our destination? It bears repeating. I can't say for sure, but it seems intent on surpassing all of our previous discussions since we started this interview. Where they usually have been. Plus, the tried and true method is simply visiting the well. I don't know if you're familiar with the saying, but it goes something like this. You try something that has worked in the past, and then you try it again, and this time it doesn't. Wow, that's unexpected. At a loss as to what to do next. Hold on a second. My last option is this. It happens every time. Effective every time. This is not the time. A small amount of panic ensues. For this reason, you may find yourself in a scenario where a lender suggests, you know what? We're going to gobble it up big time, and I'm coming out. At 42, we bought it short. At 44, we stocked up on shorts. We dominated at 46 and are now aiming to break 50. The agony is too much for me. Yeah, I'm not predicting it will, but it has the potential to have happened. A word for that exists, though. It's called backwardation. Furthermore, it signifies precisely what you stated. A backwardation occurs when the spot price, the current market price for a good or service, is more than its expected future value. This might be anything from wheat and rice to soybean oil and silver. Since I am unaware of the educational background of each of our readers, I will elaborate on this point a little bit, Danny. In the futures markets, the current price is lower than the price in the future. This situation is known as contango. Interest rates on longer-term investments, such as 10-year notes or bonds, are a common indicator of future prices. Therefore, if you have a yield of, well, as a general rule, it will usually cost more to buy something now than it will in the future. I really need it because that bar backwardation has been driving me crazy lately. Sure, I'd be happy to chip in. I'd rather have it now than pay more for it in the future. Holy cow. This indicates that there is a high level of imminent demand. Whether it's oil, metals, or grains, the physical item is in high demand, this very second, rather than tomorrow. It does show that supplies are limited. There is a lack of stock, and getting delivery in the near future is challenging. Worry about a shortage also enters the picture. Here on the other end, traders can be concerned about stockpiling. Thus, perhaps someone out there failed to accumulate sufficient silver to meet their desire for solar panels. Someone is delivering something and you need to take care of it. Implications for precious metals include the possibility that purchasers will have doubts about the authenticity of the metal in the future. And then this occurs. I am not attempting to argue a point. I am astounded. This has occurred multiple times previously. After a short period of time, the market returns to contango, when prices are often higher in the future than they are presently. Having said that, ongoing irreversibility. Assume it continues for a week without interruption. Hey, Danny, that's totally out of the ordinary. This would suggest that the paper contracts are reliable. They do not have faith in the COMEX. They have doubts about the LBMA. They have doubts about the reliability of their counterparty who keeps it in a brokerage account. The metal belongs to me. This is the wrong time for me to want it. As a result, backwardation can have a real-world impact for futures traders and investors. It's possible to make money by selling the contract at a higher price before it expires and buying it at a lower price the following month. And it's a common occurrence. For that reason, it typically returns during tangos. So, in essence, hold on a second. I could collect $8,000 today with my automobile, and I can get it for $7,000 in 2 months. It's me, baby. Dude, you should sell that automobile. $1,000 is already mine to keep, and it really does happen. Yes, the silver market is no exception. But with all that said, Danny, and I'll wrap it by asking this. What if you receive a document stating, I will give you that car for $7,000, and then you go grab it? My apologies, I made an error in the inventory quote. That card isn't mine. Then what takes place? With any luck, that clarifies the concept of backwardation and its potential applications.